Thank you all for taking some time this afternoon. My name is James Bogart. I'm CEO and President of Bogart Wealth. Before I get going, I am recording this webinar, so if you're not able to attend for the entire presentation, or if you have any friends or colleagues who'd be interested in seeing the presentation, we will be recording it. It'll also be going up on our website. Administratively, I have the question and answer box open. I also have my chat box open. They should be at the bottom of your screen. So if you have any questions, I will do my best to answer them as real time as I possibly can. But by way of introduction, so Bogart Wealth is what's called a registered investment advisory firm. We're managing approximately $980 million of client assets. It's approximately 700 households. About 90% of those are ExxonMobil households. We are true fiduciaries for our clients, so we're legally obligated to put our clients' interest above our own. Very transparent in everything that we do. We're not being compensated by any of the investments that we're recommending or any advice that we are giving. There are actually a little out of date. I added one person, but we have 16 folks on our wealth management and planning team. We've got 4 on our tax team. We have 3 offices, one in McLean, Virginia, one in Houston, Texas, and then one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. Your kids and your parents can be some of the largest variables in anyone's financial plan. We've made it part of our firm's culture to give your children access to certified financial planners. You know, a lot of you have heard me present before, but I like to say, what would you do differently now that you know what you know, but maybe back when you were in your 20s or 30s for that matter. One of the calls to action for many of the events that we do is to take us up on the opportunity to sit down and run your numbers. It is absolutely no cost, absolutely no obligation. We use it as a great opportunity to get to know each other and ultimately give you a baseline for where you're at. Given the environment that ExxonMobil is in right now, I think it's only prudent for anyone to have a plan. And if you haven't done this, I really, really highly encourage it, especially with firms like ours that aren't charging you for it. And frankly, you should consider working or having several firms do plans for you. I do think that benefits are potentially going to change in the future, and some of the options to active employees are going to change. And I really think it's in your best interest to put yourself in a position to be able to make decisions relatively quickly, given the environment that we're in right now. Today's talk is one of several events that we do as part of what we call our Retirement Readiness series. We do one on a presentation on the retirement planning timeline, the retirement income planning event. We do one on Social Security strategies, one on tax planning and tax optimization strategies, one on estate planning strategies, one on net unrealized appreciation, NUA, and post-retirement income strategies, one on long-term care insurance, one on Roth versus traditional 401ks and IRAs. We're going to be doing one on mega backdoor conversions in 2 weeks. And this is lists that's come from our audience that we've generated presentations, either made ones entirely for those events, or we'll add it to an existing one. And if there's a topic you'd like to hear us present on, we're more than delighted to add it to the list of options that we're giving. And Bogart Wealth's core competencies are financial planning, investment management, tax optimization, and tax preparation. And we do believe in having an integrated service model. And at the end of the day, the goal and objective is to keep more money in your pocket. And whether it's looking at a financial plan or different tax strategies, really is important to have those to be all-encompassing with regards to anyone's financial plan. I already had a question come in. So ExxonMobil announced a change in Australia pension plan. Is there any possibility ExxonMobil will do this for U.S. employees as well? I've gotten this one several times this morning. And yes, they did announce the change to the pension program for employees in Australia. I personally believe that it is going to be something that is indicating something will be coming in the U.S. It's hard to kind of determine when the timing of that will be. But I go back to my comment I made a moment ago. I think if there is any changes to the program, albeit an inducement or something that will incentivize employees to want to consider retiring a little earlier, I really think you need to have a plan, and now's the time to be doing it. We don't want to be having to wait and kind of structure all of that right when that announcement happens. I think it's only prudent if you're close or even thinking about retirement, you really should have that baseline level of planning. All right, so today's talk specifically is talking about discount rates and how they affect the ExxonMobil lump sum program. And so to start and kind of set the stage for this, in 2006, the Pension Protection Act was established. And what this did was it limited companies that were offering a lump sum option to their pension program. It defined the discount rates that can be used. It also defined the actuarial tables that can be used. It clarified a couple other things regarding retirement accounts. Specifically, non-spousal beneficiaries can receive rollovers. It also clarified that after-tax balances can go to Roth IRAs. It was also when the company was then forced to allow for a diversification option for the company match. Many of you might remember that in order to get the extra 1% on the match, you had to go and have it go into company stock. Post 2006, that was when you still got the extra 1% match, but now it's diversified. Now, obviously at the moment, ExxonMobil has suspended the 401k match. Very uncertain as to how long that suspension will be. I do think that also needs to be incorporated in anyone's financial plan because that can have a relatively material impact on long-term savings. And we should also talk about how you're saving now. I do think that it will present some opportunities. Specifically, one of them is the mega backdoor strategy. I'm doing a whole dedicated presentation on it. And I should have actually probably mentioned all of the presentations we've done in the past are up on our website. They are recorded. If you'd like to watch them, feel free. And then obviously I'm going to be redoing some of them as data continues to change. But back to today's talk. The Pension Protection Act also defined IRA and 401k contribution limits and what they're going to be going forward. So prior to the Pension Protection Act, there was a category of households that we define as grandfathered. And this was anybody who was over the age of 50 at the end of 2007 and had more than 10 years of service before January 1st, 2008. Another way of describing it is you were 55 and had 15 years of service before December 31, 2012, or you're born before 1958 and hired before 1998. So the math for this age group is actually relatively simple. We take 95% of the 30-year treasury rates within the quarter. They round up or down to the nearest quarter point. The other part of the math for this age group is they use the ExxonMobil year 2000 mortality table. So yes, that mortality table has not been updated in 20 years. Now, when we look at 30-year treasury rates, they've actually been on a pretty consistent downtrend for the last 40 years. Obviously, we really specifically look at this time frame here. And one of the things that we do is every single week we send out discount rate projections for both grandfathered and for non-grandfathered households. This is a snippet from the one that I sent out on Monday this week. But we do know that the fourth quarter rates are at 1.25% for grandfathered folks. Our projections are that they're going to be 1.25% for the first quarter of 2021. Based on where the 30-year treasury rate's at right now, 1.43-ish%, pretty high probability that we're going to see that the discount rate stay at 1.25 going into the first quarter of 2021. All right, so then there's a second category. This is essentially everybody else. And it's those that were under the age of 50 prior to December 31, 2007. And for all of you, essentially the new Pension Protection Act rules apply. And so here we use three segments based off of high quality corporate bond yields. These yields are published by the IRS every single month. Historically, they're about 2 weeks delayed. So we obviously have the July rates officially in the system. We are now waiting for the August official rates to be put into the system, which I anticipate we'll see probably again somewhere around the 15th of September. Now, corporate bond yields are higher than treasury yields. So higher rates mean smaller lump sums. Now, the other thing for this age group is they use the IRS mortality table, which is released every single year. And because it's released every single year and it's now 20 years updated, the mortality rates have had folks living longer. So obviously this is affecting anyone who was retiring starting in 2013. You were born after 1957 and hired after 1997. Now, these three segments, and again, this is a snip that comes off the weekly piece that I send out. And by the way, for both pieces, if you'd like to be added to the distribution list, send myself or anyone on my team an email, and we're happy to add you onto that distribution list. But there's 3 segments: segment 1, segment 2, and segment 3. And I have an example that kind of shows the calculations and how it applies. But segment 1 is mimicking short-term bonds. Segment 2 is mimicking, intermediate term bonds. And then segment 3 is mimicking long-term bonds. And right now, we do know that the fourth quarter rates, which is the second to bottom column here, was a new historic low that had come in. And these are the ones that are officially being used in any pension calculator right now. Segment 1 was at 0.91. Segment 2 is at 2.68. Segment 3 was at 3.4. And what we do is we create the single rate equivalents. So for somebody who's retiring right at age 60, and then somebody who's retiring right at age 55. And I'll explain how they're different here in a minute with this example. But for anyone that is retiring right on their 60th birthday, the blended rate comes in right at 2.72%. For anyone retiring at age 55, it's right at 2.84. And now, and we know, by the way, that those were about 25 basis points and 23 basis points respectively, declining off of the third quarter. Now, we are projecting the first quarter of 2021 rates now, and obviously these are projections. Now, the rates for this age group are actually very different than the grandfathered folks. Grandfathered folks use the entire quarter, and we take the average. For the non-grandfathered folks, it's only the last 2 months of the quarter that will determine the preceding quarter's discount rate. So specifically, July had no impact truly on what the effective rate's going to be. The discount rate is going to be solely based upon what happens in August and what happens in September. And so we will have the official first quarter of 2021 rates about the second week of October when the IRS and Treasury Department publish those. As it stands today, as of Friday's close, we are projecting that the first quarter rates are actually going to be lower. Right now, it's a 39 basis point decline off of what we're seeing in the official fourth quarter rates. So to talk a little bit about how those rates apply, we use a very, very simple example and just illustrate for somebody who is retiring in the fourth quarter right at the age of 60, and we're using the 3 segments. So as I mentioned, segment 1's at 0.91, segment 2 is at 2.68, segment 3 is at 3.48. We also know that in this example, the annuity payment would be $4,773 per month or $57,279 per year. Now, the way the rates work is segment 1 applies to the first 5 years, and that's essentially what this table over here is demonstrating. Then segment 2 applies to the next 15 years. So segment 1 would apply from age 60 and through age 64. Then segment 2 would be the next 15 years, so age 65 through age 79. And then segment 3 applies to everything else, so age 80 to 83, and that's where you can see the higher rate here. Now, when I go back and I talk about the difference between somebody who retires at age 55 versus somebody who retires at age 60, it's because an age 55-year-old will have more exposure to segment 3, which segment 3 is the highest of the 3 rates, which is ultimately why the age 55 retiree will have a little bit of a higher effective discount rate. And obviously you can extrapolate it in between. So if you're retiring at 57 or 58, for example, you're going to have some incremental exposure at a higher level to segment 3. Now, as I mentioned, first 5 years, segment 1, next 15 years, segment 2, anything else is on segment 3. Obviously, this is a simplified example just showing a $1 million present value lump sum. We have a planning tool that we use to audit all of ExxonMobil's calculations. Part of our planning process is to build that in. So if it's something that you'd like to see and we're happy to help calculate those for you, please feel free to reach out. We'll do it as part of the planning process. Now, in terms of impact of interest rates on the lump sum and what that means in terms of material numbers, this is again using an example of an approximately $1 million lump sum number. And one of the things that we commonly tell folks is general rule of thumb is a 1% movement in interest rate is about a 10% differential to the actual lump sum rate. So rates have been on this downtrend, and you've seen in both the segments and even in the grandfather folks, rates have continued to trend down. And so, for example, on a $1 million lump sum, rates going down by approximately 1% is almost the equivalent of about 100,000. So on the way down, it's 9.5%. And then if rates actually were to, I went the other way here. Rates went up by 1%, it's approximately a decrease of about 9.5%. And then on the way up, rates go down by 1%. It actually is about an increase of about 11% on the way up. So that's an increase in the lump sum value. So lower rates mean bigger lump sums. And as rates rise, we're going to see the lump sum starting to be impacted. And so common discussion we're having with folks, if we're getting very close to retirement, I call it the red zone, using a football analogy. But when we're that close, we really need to monitor interest rates, especially if you're within what I would call 6 months and in, because rates can have a material impact quarter over quarter. Now, there are a couple other reasons that we need to, or a couple other factors that we need to bring into consideration. If you're under the age of 60, ExxonMobil will impose a discount on your pension program. It is approximately 5% per year. And so if you're under 60, we got to look at how that's going to have a material impact on the lump sum. And so one of the conversations we need to have is when to consider delaying taking the pension. Now, once you've attained age 55 and had 15 years of service, you could retire at any point in time and make the choice to continue to delay taking the pension program or the lump sum option. And why you would consider doing that? Well, first off, you don't need the money right away. Second off, you're under the age of 60 and we're trying to minimize that discount that I mentioned. And third, we're taking the lump sum and we're expecting interest rates to continue to fall. Or if you're under 60 and even if they just stayed flat, we'll continue to delay. So we've got a lot of folks right now that even if they're retiring in 2020, but because we're projecting rates to be lower in the first quarter of 2021, that's going to have an impact on ultimately when we execute. They can retire, but we're going to delay commencement of those benefits. Now, part of our process is helping you build out that timeline, and we call it our roadmap, but it's helping with illustrate what some of those critical dates are going to be and understanding when things need to be done. Because again, when we talk about that football analogy of being in the red zone, this is when we need to have flawless execution. We don't want any fumbles. We don't want any interceptions. We want to make sure that we're optimizing to the maximum extent. And here's those dates. And so this is just an example of showing a December 1st, 2020 benefit commencement date. And so the earliest an employee is eligible to request a package is 120 days out. It's recommended to do it 90 days out. And you'll need to know the 3 critical dates. So it's going to be last day on the payroll, first day of retirement, and then the benefit commencement date. And obviously, if this is a December 1 benefit commencement date, then we need to have a conversation and back in what the first day of retirement and last day of the payroll are going to be. So the earliest this individual would be eligible to request the package was actually August 3rd. Now, it's taking them approximately 3 to 5 weeks to get these packages out to employees. Once you receive that package, I highly, highly recommend have your advisor sit down and complete the package with you. I would talk about Bogart Wealth. We've done hundreds of these at this point. Most retirees, it's the first time they've ever seen this package. We're making some irreversible decisions here. We want to make sure that we're executing correctly. Now, for the standard package, there's essentially 2 places that the employee needs to sign and have notarized. And if we're taking lump sum, we need to have the spousal consent form signed. So if you're married, your spouse has to sign and notarize. For anybody who is in the highly compensated category or an executive, there's an additional form, the non-qualified pension election form, that's going to also need to be signed and notarized by the participant. And then after that, there's a couple other places that are going to need to be just signed and wanting to make sure that we execute those forms correctly. Specifically, I recommend the direct debit authorization form. That's the form that allows medical benefits to be debited out of your checking account. I also recommend if you have a supplemental pension plan or additional payments plan, we fill out the direct deposit authorization form. And then also in that package is information related to how to adjust or change any of the beneficiaries that are on the plan. So whether it's your healthcare your life insurance programs or the pension or the savings plan. And if you have a non-qualified pension, how to change those as well. Now, again, for somebody who is retiring with a December 1 benefit commencement date, in order to have everything processed correctly or on time specifically, we need to have that package back to benefits 35 days prior to the benefit commencement date. So in this example, it would be October 27th. Now, again, with December 1, you're going to receive the benefits paid to you somewhere around the 1st. Historically, it's been a couple days prior. But you do, if you have a supplemental pension or a additional payments plan, we have those deposited directly into the checking accounts. The qualified portion of a pension program actually will be mailed as the form of a check. It gets paid to whoever the custodian you choose is for your benefit. So it can't be deposited in anyone else's account, but yes, it is mailed. And so we recommend as soon as that comes in, get it to us or whoever your advisor is, get it deposited into your custodian so that ultimately the money is not floating around in limbo. Now, after you've retired, and by the way, you are not forced to have a conversation around the savings plan once you've retired, but after you've retired, you have the ability to roll the 401k out. The default that I always tell folks is make sure you're comfortable with the math, understand the tax implications. The default is leaving it at Voya, and that's totally fine and totally acceptable. You really have all the way up until age 72 before you have to make a decision. And the reason, by the way, I say age 72 is specifically that's when required minimum distributions start for most employees. And if you do have low cost basis shares and you're going to go after things like net unrealized appreciation or some other strategy, that would then potentially prohibit you from taking out and taking advantage of NUA. I got a couple questions that have come in, so I wanted to make sure I answered those. So does the 5% yearly penalty in effect if I'm 55, retiring November 1st, and transfer the lump sum into an IRA? So if you're commencing benefits at age 55, yes, that early commencement discount will apply. And so when you get your package, you're actually going to see a specific line item that says early commencement discount. And so it will be, if you're 55, it'll be 75%. If you're retiring at 60, you'll see it say 100%, means you're going to get 100% eligibility on that. But you do have the ability to potentially defer. So if you're 55, and again, in this example, because we're seeing rates trend down, you do have the ability to defer the qualified portion of your pension program and reduce some of that discount. So for example, I have clients of ours that are retiring right now at age 55 or some form of that prior to the age of 60. And because we're seeing rates trending down and because ultimately just leaving it there reduces some of that discount, well, then in that case, let's kick the can. Now, one thing to point out with the non-grandfathered folks, which is essentially anybody that we're talking about that's under the age of 60, in order to take advantage of that quarter's interest rate, your benefit commencement date has to be within that quarter. So for example, if you want the fourth quarter rates, your benefit commencement date has to be this example here of December 1st, 2020. If you want the first quarter rates, you can have as early as January 1, 2021 and as late as March 1, 2021. And that would take advantage of the first quarter of 2021's interest rates. Now, typical rule of thumb for me is I like to go after the guaranteed free money. And I will say, based on where market valuations are at right now, I really do like the fact that if you're under the age of 60 and we can continue to get 5% a year approximately with essentially no risk because we have a full arbitrage on knowing what rates are going to be before we have to execute, I'm a big fan of leaving the pension, the lump sum program there, assuming, obviously ExxonMobil doesn't make any changes to the program, which as of late, they have confirmed that they're not eliminating the lump sum option. We've had that rumor a bunch too. But there is something on the internal benefit site that did confirm that they have no intent of changing lump sum program for anybody who's already vested. All right, I've had a couple other questions come in. I want to make sure I get to these. So based on projections, what would be the value difference between a lump sum of $1 million on December 1, 2020 versus a benefit commencement date of 2021? So I go back to that comment talking about approximate adjustments on discount rates. So if we're looking at approximately a 40 basis point decline, that would be a 40 basis point increase, approximately 4% increase. So on $1 million example, then we would see the $1 million increase to 1.04 million just by waiting. Now that's assuming somebody is age 60. If you're younger than 60, you're actually going to get approximately 12.5 basis points more. So it would actually take the 40 basis points up to 52.5 basis points. So it'd actually be closer to a 5.25 increase. So it'd be $52,500 just by waiting on commencement for a quarter. And by the way, delighted to show you with our pension tools what the actual implications would be along the way. All right, So I've had a couple other questions here. Frequently asked questions on the suspension of the company match contributed to the savings plan have been updated as of today, September 1st, 2020. 2 items of interest. Are you planning on making changes to the ExxonMobil pension plan? Oh yeah, so someone is just commenting. At this time, we do not plan on making changes to the pension plan, which includes the lump sum. Employees with 5 years or more of service have vested pension benefits that have earned to date. The company cannot take away vested benefits that are actually accrued, including the pension or lump sum option. If there are changes to the pension in the future, they're going to be on a go-forward basis, not impacting accrued and vested benefits. I appreciate you sharing that just so I could read it, but yeah, that did come out this morning. Can ExxonMobil actually suspend the lump sum without notice? No, I think I just actually answered that question. Do you circulate this deck to participants? Yeah, absolutely. Can circulate the slides, can also circulate the recording of the event, and the recording is going to be up on the website probably tomorrow at this point. All right, a couple other questions that came in. Did the lump sum calculators at ExxonMobil already include the discount for early retirement at 55, 56, et cetera? Yes, they do. One thing that I would be very cautious on when you're using the calculators at ExxonMobil is if you have anything in there about salary increases. You know, some folks almost accidentally include an assumption that their salary is going to continue to increase. I think from a prudence perspective right now, I would not model a pension projection with assuming even a 2% or 3% increase at this point in time. I don't think that that's going to be happening in this environment. I'm vested in the pension plan over 60, but not retirement eligible due to years of service. Am I qualified to receive the lump sum if I leave prior to becoming retirement eligible? So in order to be eligible for retirement benefits, you have to be over 55 and have 15 years of service. So the answer is if you left prior to the second part, which is 15 years of service, you would only be eligible for the pension program, not the lump sum option. You also wouldn't be eligible for retiree medical benefits, which is another conversation that I think we need to have related to timing for your case. What's my gut feel for interest rates for the remainder of 2021? Well, to be perfectly honest, my gut feel is it's hard for me to imagine them going much lower than they have. And we have actually seen in the month of August, they've started kind of doing a little bit of a U-shape and trending up. September thus far is flat. You know, so what's going on with corporate bond rates right now? I'll talk about treasuries, I'll talk about corporate bonds, but corporate bond rates are being very much influenced by what the Fed is doing. So over the last couple of months, part of stimulus initiatives that the Fed has done is they have been the active buyer of short-term, high-quality corporate bonds. And they've actually gone down the credit spectrum. So it's not even just high-quality corporate bonds. They've started doing some short-term high-yield and junk bonds as well. So, and they've also committed that with the overnight rate, they're going to continue to do what they're doing through the end of 2021. If I had to guess, they're going to continue to be the active buyer, which is really directly impacting segment one. You know, going back to just show my the actual calculations, we saw segment one do a dramatic drop between the first quarter of 2020 and the second quarter. I mean, it's over a whole 1%. And that really is in large part from what the Fed's doing. And I think that we're going to continue to see that trajectory here. The question really will be what happens with segment two, because segment two covers the next 15 years on any of the pension calculations. That ultimately is the one that has the most material impact on what the discount rate is going to be for most annuitants. And if I had to be a betting man, I would tell you that I think rates are going to kind of be range bound at a lower level for most of 2021. But I do think that there is going to be some upward pressure, especially as the economy starts to reopen. And I do think at some point in here, the Fed is going to back off on what they're doing. And when they do that, so as I mentioned earlier, the Fed currently owns approximately 60% of high quality corporate debt and short-term corporate debt. If they let off the throttle at all, we're going to see short-term rates move pretty quickly. And when they do, it's going to be relatively dramatic. That said, you know, I made the comment a moment ago, and I'll reiterate it. If we're already at this place where we're watching quarter by quarter and we're getting ready to go, we have a full arbitrage on being able to determine the appropriate quarter. So going back to kind of this timeline here, excuse me, where, as I mentioned, for a December 1 benefit commencement date, we have to have our package back by October 27th. So we will already know the official first quarter rates before this package is due back in. So we will know for sure what first quarter of 2021 is going to be. And if they happen to move up, which I think is relatively low probability at this point in time, but anything's possible. We actually, by the way, in the month of March of 2020, we saw rates where initially we're projecting down to new historic lows, and then they skyrocketed up for a 3-week period of time there in March based on the volatility we saw. But the point is we will know what rates are going to be for the following quarter before the package is due. And so for a lot of our guys who have already retired and left, they're under 60 and we're just playing this waiting game with them, you know, for all intents and purposes, we can wait and we can continue to kick the can and see what rates are going to be in the following quarter, and then we can execute. Now, by the way, you can always request a package even after that 90-day recommended window. All it does is it doesn't guarantee that your benefits will commence on time. So I have seen instances where employees have waited until the day before the benefit commencement date and then just quit, and then still been able to take advantage of that quarter's interest rates because we actually had seen rates were going to move very dramatically up. I don't recommend it. I really don't. And I prefer to have more planning and timing ahead of it. But it is something that's available to you. But as I mentioned, you got to have other money to be able to live on, because that will cause delays in some of the other benefit programs coming out. All right. You know, the big theme with all of this is we got to have a plan now. Understand your budget, understand your cash flow needs, and especially if you're in a situation where your timeline is moving up, we need to understand what you're going to need to be spending in retirement. We also want to make sure we understand our risk profile. You know, if your goals and time horizons have not changed, your investment portfolio shouldn't change as well. Your risk profile 100% needs to incorporate short-term needs, intermediate-term needs, and long-term needs. And making investment decisions emotionally, whether it be out of fear or greed, without a doubt is not a long-term investment decision. And that's why whatever your cash flow strategy is needs to be incorporated with your investment strategy. And that all needs to be coming right back into the plan itself. So I do have a couple other events that we're going to be doing coming up. On the 16th, I'm going to be doing the Mega Backdoor Roth. I'm also on the 23rd going to be redoing our retirement timeline presentation. And then on September 30th, I'm going to be doing retirement income planning. All of these we're going to continue to record. If you can't dial in, please feel free. But as I mentioned earlier, we will be delighted to take advantage of the opportunity to visit with you and do a one-on-one plan. We'll run all the pension calculations. I can show you relative to what the projections are showing you. You know, the real challenge I have with the projection tools is that for anybody that's in that non-grandfather category, they only let you move them up or down by a 1% increment. And so that's why we built out the tools that we have to be able to show some of these sensitivity points. And some of it does come into cash flow needs as well as timing of retirement. But again, absolutely no cost, absolutely no obligation. Would love the opportunity to visit. And here's our contact information. You know, this is myself as well as my advisors. And then Mindy from my team is going to follow up just to see if you have any questions and if there's anything we can do to help. But most importantly, please stay safe and stay well. Thank you for the time today, and delighted to be a resource however we can help. Appreciate it.